free for iPhone and Android devices.
Mark Vittner is Managing Director and Senior Economist at Wells Fargo Securities in Charlotte, North Carolina. Good morning and welcome, Mark. So do you see anything in this week's economic reporting that might give us any more clues about the Fed's timing?
I still think it's going to be pretty tough for them to begin to taper in December. We've got the short holiday season. Retail sales looking a little skittish. I mean, the numbers looked okay yesterday. They weren't better than expected. They actually came in either right at expected or a little bit below expectations, depending on where you were. And there's just no pricing power. There's a lot of talk about how the Fed needs to pay a lot more attention to the lower end of their inflation target. And I think that's where the focus needs to be. Nominal GDP is only up 3% over the last year. That's typically levels that would be associated with a recession.
Okay, hello and welcome in from Sunnyvale, California. I'm Mark Vierra, and this is my weekly basic technical analysis video. I'm not making any buy or sell recommendations, just sharing with you some basic technical analysis. So the market's been running up, been seeing some nice fresh all-time highs on the indices, and I'm going to take a quick rundown on the charts. We got a nice current monthly candle is quite bullish. Keep moving this resistance line up and up until we're going to see more of a channel if this continues. Of course, we'll get into stock market and parabolic here in a minute, but take a look at the weekly. We're talking about there's a weekly channel trend lines. Zoom in a little bit, take a look. And this candle just poking its head up above resistance. I got 1808 marked, would be continuation up to this channel line. And if we see a spike up above that, we're looking at a whole new trading range, and that is something very interesting. Weekly fib extensions are marking in a pretty good support and resistance here. I always throw in the $1.25. That's this would be this distance added to down here. This would be the 100% leg, and we're just zooming through these levels. And 1800 is your key psychological even number level that we're dancing around right now. But this would give you a longer, more intermediate term support and resistance. And we'll move into some daily trend lines. I've got a lot of daily charts here, getting ready for my weekly log. This is the upper end. I drew this line very conservatively. And now this in here, this is sort of a freehand through these gaps. This is a very subjective, I move it around here and there, giving me a very loose kind of a pivot line. Very, very subjective kind of a thing. Here I've drawn at the high from here to the high of here. And I'll get into another chart here where I'll lower that down. But this is a rising wedge. I think up here at the 1812 area where my arrow is pointing is going to be some firm resistance to get through that. Now if above that would indicate a whole new trading range, and that's a whole new ball game. I'm not expecting that to happen because this, if you look at the distance between the pullbacks here, this is the nature of a wedge. And the rising wedge is a bearish pattern, and it's basically saying that parabolic is only going to last so long. So I think what we're seeing, and I'll get into volume, kind of confirms this too, how it's a higher price. That means you're going to have a less of an interest. Okay, I think you're going to see more supply entering the market at these higher prices, especially, and I noted in my log, at the end of the year, you're probably going to see some profit taking. That would be my best guess. Now, here's where, I'm taking the subjective, this pivot here. this would be more of a firm from the high to this high, and between these two lines is going to be my very conservative no-brainer. Above that's bullish, you know, say 1790, below 1790 is bearish, above 1795 is bullish. And that's, you know, take it for what that's worth. Let's see, these are support and resistance lines. I've moved my, this is an Andrews Pitchfork. Interesting tool to play around with. I've just recently moved it up as we've got off of these two lows and this high, and then you get this channel, and just to show that we're just central in this type of a range, the way that the market's been moving up, I'll use the Andrews Pitchfork to show a different perspective, and you can kind of compare that here to the regression channel. Now this is a 3-year regression channel, and this puts it into a different perspective where we're really at the high end. And of course, and you can see back here, when you get to that high end, we jump down into this lower trading range. Right now we're at the peak of a trading range, so that's where you want to use extra caution in terms of, you know, should I enter the market long? Not me. I'm gonna wait. I have long positions. In any case, this video isn't about you know, qualifying positions. It's more of just, here's some technical analysis to look into. Now this is an interesting divergence when you're looking at an oscillator, and I'm seeing lower highs on this oscillator and I'm seeing higher highs. This is telling me that there is some bearish divergence. Also, again, we're going to look at volume here in a minute to give us an idea, you know, how valid that is. Let's see, moving averages. The only thing on these moving averages, lagging indicators, don't put too much stock or faith into them. I've got a Bollinger Band in here where we're breaking up above this Bollinger Band. And eventually we are going to head back down to the 20-day standard moving average. Don't know when that's going to be, but that's just an inevitability. And to note that we are 70 handles from this 50-day moving average. So that, as a trader, should put things into a little bit of a you know, perspective. Now let's take a look. Before we get into volume, don't have too much for patterns. A lot of the targets have already been met. You know, there's just not enough you know, sideways movement to develop these patterns. But we did have a V top, and we formed a V bottom out of this. This is a if you look at this as a flagpole, we've got a bullish flag. The target for that would be up near the 1820. That would be an equidistance to this flagpole. Added to the bottom of the flag is how you measure flags. And also it would be a measured move. You know, the distance from this leg here added to the lower in here would be heading for a measured move type of formation. I've also noted that we've busted above this rising wedge, so we're threatening to break out into a new trading range. Of course, and we're going to get into volume. I don't think that we're ready to enter a new trading range yet. Maybe next year, but I think in the next few weeks, I believe we're going to see price settling down a bit, and I think now would be a good time to take a look at some volume. Let's open up the daily. Okay, now this is a 3-month daily chart. Each candle is a daily, and I'm going to shrink myself down here, and let's just go over what studies I have here. Of course, now everybody's familiar with volume by time down here. This is an MACD, just a 2-line oscillating moving average. And this is relative strength, is just your basic no-frills oscillator. Up above here, this is volume by price. So we can see these volume nodes, the more activity you'll see, and now the highest activity, this would be your point of control. That's the most shares trading, changing hands at that given price. What else do I have in here? Let's see. This dashed blue line is a VWAP, volume weighted average price, and these dots are showing an upper and lower channel to that VWAP. The rest of this stuff in here, these little triangles and circles, this is a study. It's a volume, VSA, volume spread analysis for dummies. It just kind of confirms for me. I can look these symbols up, and it's analyzing the amount of volume and the type of candle, and that's very meaningful, volume spread analysis. So what do I see in this chart? Of course, I've got the same rising wedge drawn in here. I want to note how this has become a pivot line, and it's also right here at this last week. This is where this volume node was, and now this week here it is, and how much it's grown. And I haven't really changed these notes from last week. I'm looking at a lot of the same volume nodes here. This is what I'm looking at would be an ideal candidate for this point of control for the 3-month time frame to move up to. The declining volume here, all right, as price moves up, tells me that first of all, well, the fact that prices moved up means that there has been a lack of supply, and that increases price. Now, the lowering decline in the volume as price gets to these higher levels tells me that that decline in interest means that we could very well see supply entering the market. Now, I would love to see a huge volume spike like this here with an upthrust candle, which is an upthrust candle. An example of that would be this one back here is an upthrust candle, but this is sort of a fake out, pseudo, where I want to see one of these up here, and especially on the weekly chart. If I see an upthrust candle on a weekly chart, that's going to be a no-brainer for me. That accompanied with higher volume means that there's profit taking going on, and you could expect lower prices. It's not set in stone, but it's fairly reliable. In any case, let's see what else can we go here. The hourly time frame, not really much to note. Not anything really jumping out at me here. I'm kind of looking at this as a weak inverted head and shoulders. Not much of a right shoulder, unless you want to consider either here or here. Of course, with an inverted head and shoulder, you need either a horizontal neckline or a down sloping neckline. So that my neckline would be from here to somewhere in this area. It's really this is an ugly, representation of an inverted head and shoulders anyway. Conversely, the neckline, if this was a head and shoulders, you would need an upsloping neckline. I see traders drawing necklines just, incorrectly. And in any case, just want to move on. Let's see. Now, here, these shaded areas, this is a Monkey Bars volume profile, Thinkorswim platform. Got the same volume by price study in here, the same rising wedge, and price is poking up above the playground and it drops back in. We are currently above the playground, and originally, a few videos back, I was expecting an expansion down here to overlap. That hasn't happened. Of course, as activity on this volume node increases, we're going to see this playground area expand. Now the playground area is this is where 70% of the trading activity is taking place. So that's the reason for this, and it's marking out an area where you have a point of control for that period of time. That would be these are the actual monkey bars. This would be the 3-month point of control down here. But within the playground time frame, this is another type of point of control where most of the activity for that period of time is taking place. And this is showing value, the upper and lower ends of where your better odds are for placing trades now. So where am I going from here? Hourly, I'm seeing less gaps between these playgrounds on the hourly. So just like back here, we found a foothold, dropped below the point of control. This is a 10-day time frame. So this would be your 10-day point of control. This was where the high volume node pivot was, and now it's the point of control. So activity increased rapidly there, but the less gap between playgrounds, the lowering of the volume, this is looking to me where I would expect some supply to enter the market. Now I'm going to take a look at, everybody's looking at the VIX. Yes, the VIX is quite low. Can it go lower? I believe it could. This is just showing complacency in the market. I don't think it's really a big deal, but yeah, the VIX is low, it's time to go. The VIX is high, time to buy, yada yada. In any case, to me, the singular event that's taking place here is, let's back out of this here. Let's do this. This is a longer term look, and I'm comparing the S&P 500 to U.S. Treasuries. This is TLT, this is a 20-year Treasury ETF. And the bond market is far more intelligent than the stock market. And whenever you see in any sovereign nation, you see a decline in 2 years in the bond market. This is setting an ill precedent to me. And that would be a longer term view. I think the decline in the bond market is not good for the stock market. Now, on the short term, that's different. You have scared money is buying dollar U.S. Treasury assets to be safe. And if we look at the short term, now let's go back to this U.S. Treasury chart. I'm seeing some bullish activity. This divergence here, these lower lows compared to our oscillator, and we're seeing some higher lows. This is a little bullishness in the background. And this last video I had a trend line here on the US dollar. I think it's a very similar chart. We got to that lower end, and we're going to see a bounce. I think we're going to return. Treasury is going to return up to at least to the point of control area. I think if you also look at, let's go back to that. Let's go back to this chart. You see here, we're putting in a base level. So I think Treasuries are finding a base. I think we're going to see some strength returning back into the bond market, at least for the near term. Now that doesn't necessarily always mean it's bad for stocks, but it's not good for stocks. So that's what I'm looking at. Also, let's take a look at the dollar. I'm watching the euro. I have no positions in the euro, but I'm seeing that our dollar's losing steam up here. Got a lot of topping formations. And if I look at the euro now, I'm still looking at this as a really ugly head and shoulder pattern. I've got, this, you could call this a neckline. You could call this a neckline. It's really kind of sloppy. And last video I was expecting some weakness in the euro. We saw a little bit, but quickly bought up. Euro is currently bid, but yeah, we'll see what happens. I am expecting some near-term weakness in the euro. Now, again, I don't have any position on it. I would wait. For me, $1.27, $1.28 would be a no-brainer price to go long, and a $1.37, $1.38 would be a perfect ideal to go short. And if it doesn't get to those areas, I won't trade the euro. That's just the way I roll here. So what else? Where else am I going here? So we can talk a little bit about, the market is at all-time highs. If you're an investor and you saw these huge prices in 2010 and you got out of the market, or all-time highs in 2011 and you got out of the market, what can I tell you? The market can keep climbing. No one knows when there's going to be the inevitable drop or pullback in the market. If you're one of these guys that got out of the market, you can do me a favor. If you ever decide to jump back in the market, send me an email. I want to know so I can exit my positions. Oh, that was uncalled for. I apologize for that. I'm sorry. That was just mean. In any case, before I stick my foot in my mouth any further, let's wrap this video up. I want to talk to you. The last thing is HotStockMarket.com. This is a forum. Now, I'm not getting paid. This is just where I hang out, and this is by far the best stock market forum on the internet. And if you want to learn more about technical analysis, here is an educational section. There are no such thing as dumb questions here. And I mention it because this is where you can find the information. Okay. All you YouTube listeners, I've included links to all this stuff, my trading log, and also there's another interesting place to find information here would be on Reddit. There's a stock market section here on Reddit. And that's it. Happy Thanksgiving, everybody, and safe trading.